regulatory environment for brokers. They operate under the suitability standard. And can you describe a little bit about how that works?
The suitability standard. We're talking about not exposing or not exposing clients to a particular amount of risk, and etc. Suitability. On a new account form, when you open an account at a brokerage firm, there's going to be a couple of questions regarding how much risk you're willing to take. Low risk, medium, high, speculation. Brokers, what they do is they usually help their client fill a form like that out over the phone. And so you go through, your name, your date of birth. In this instance, we're only buying 100 shares, so it's speculation. We're looking to make big money here, right? So let's check speculation. And you check speculation, that means if you get wiped out, you try to take that broker to court, you're probably not going to win. Because you filled out paperwork that you signed that says you're looking to speculate. If you check low risk and I lose you 60% of your portfolio, I'm in trouble as a broker because obviously I did something wrong if you take me to court. Right. But we're taught, in our sales meetings, we're taught, listen, get your client on the phone, change this to speculation. Change it to speculation. What if the stock goes down? Change it. You don't want to be in trouble. Brokerage firms don't like to be in trouble. So basically, if your account has speculation in it, and you lose your whole portfolio, nobody's responsible.
Wow. And is this a sales tactic that's used in the training to tell people to check speculation?
Well, they tell us to do that, obviously. This way, you're not liable in case stocks go down. And we pick volatile stocks. Picking a ABC Corporation that yields 2 or 3% a year isn't really exciting for a broker because you're going to hold it for months or years and you don't get paid on that. You get paid for buying and selling. That's basically it. So if a stock goes up 10, 15% in 3 days, I have the ability to take profits and put you into a new position. Obviously, stock can go down 10% in a day.
Right.
I can sell it, get paid, buy something else, get paid again, and take no responsibility or liability for what just happened.
So we mentioned speculation. How does margin work in with this? Because people can use margin when they're investing. Can you just talk a little bit about how that affects clients and how that works as a broker?
Sure. Margin is very interesting to me. It's basically money that's not yours that you're using to purchase stock for buying time. In most cases, margin is never brought up until the client can't really send you any more money. So, for example, your account is $600,000, and market volatility, commissions, markups, your account's all of a sudden $450,000. Okay, and I say, John, send more money. We're gonna double down here so that we can make more money when the stock goes up, and you just can't send me any money. You can't. You're tapped. You have no more money. For me to make your account larger, I'll use margin. And you're allowed to borrow up to your value of the account. So if the value of your account is $450,000 cash, I can borrow an extra $450,000. Okay, this way, your account's $900,000. A 10% move is a lot bigger in a $900,000 account than it is in a $450,000 account. Okay, obviously it's a double-edged sword. If the stock goes up, great, you made more money. If the stock goes down, extremely detrimental. Stock goes down 20%, you're fully margined, you're down 40%, just like that.
Right.
And you're gambling with money that's not yours, and you have the potential to lose more than you've invested.
Would you say clients are made aware of the additional risks they're taking on when they have margin in their account?
Well, they are in paper and lawyer language. If you're not a lawyer, it's really hard to understand what it is you're signing, because you have to sign a margin agreement. It's hard to understand. So who would you ask? Your broker. Your broker would love to tell you all of the benefits of using a margin account. Sure, your broker might mention, yeah, obviously, it can go down a little bit, but I'm really sure of this one. Let's just use it this one time. It's all sales. You buy it because of sales. You sign your life away and all of your money just because it sounds great. I have to buy it. I have to, greed and fear.
Right.
If you're greedy, you're going to put as much money as you possibly can to make your money back, or just to make more money. In fear, you don't want to end up being down 25% at the end of the year. So, oh my God, I got to make money back. You use margin. So, it's emotions and broker excitement. Whether you're made aware of it on an individual level, I don't think the risks are exposed as much as they should be.
And with margin, it's possible to lose more than you originally invested, right?
It really is. Usually you get warnings. The clearing firm will give you a call and say, listen, you're almost tapped out. You're getting close. You're getting close. And there's a regulation where there's an X amount of money needs to be in the account just to make sure, if you have a crash or even a flash crash, that you don't owe the money, right? And obviously a broker does not want to owe anybody money, because if a client owes a broker money and doesn't pay for it, it comes out of the broker's pocket. As a broker, you're going to get on the phone and say, listen, we have a maintenance call, we have a house call. You have to send, 10,000, 20,000, or whatever, 100,000 to, for a requirement, because we need an X amount of money. You just send it. You have a choice as a client. Oh my God, I have to send money. And they tell you, yeah, your credit's gonna get hit or whatever it is they tell you, whatever the reason is. They're gonna make you send money.
So when you get a client, when you open a new account, how long do you expect to keep that client, and what is the typical life cycle of an account?
Well, all brokers hope to keep the client forever. I'm sure that's the intention. Every time you pick up the phone, you want that whale, that multi-million-dollar guy, and you want to keep him for as long as you possibly can. But it never really works that way, as far as I've seen. I've seen accounts get wiped out real quick. If I had to give an average, I'd probably say 9, 10 months. So obviously sometimes a lot faster, sometimes longer. Sometimes you a client's more conservative, so you're not going to churn them and burn them as fast as somebody else. If you got to eat today, you're going to churn them and burn them. If 2 of your top clients die or leave, you go, oh my God, half of my book is gone. What do? I have to make money. So I'm going to go to my smaller guys and I'm going to say, listen, in, out. We're going to generate a lot of commission. And we're going to get a paycheck. That's what we do. And there's contests. You come in the morning on October 1st or November 1st, and they say, listen, the person that opens the most accounts gets this. The person that raises the most money gets this. The person that does the most gross or the most commission gets a prize. You're rewarded for charging your clients for your service. You're not rewarded for picking the best performing stock or having the best performing portfolio, best customer service. No. It's about how much money you're making for the brokerage firm. And they give you incentives, Super Bowl tickets, cruises, whatever have you. Whatever it is that's going to get you to call your clients, raise money, charge them commission, in and out, and make the brokerage firm money. That's it.
Okay, so you mentioned the incentives that you can get for opening accounts or selling. How is a typical broker compensated?
Most brokers outside of your Morgan Stanley, Merrill Lynch, UBS, it's all commission. A Morgan Stanley, Goldman Sachs guy will get paid, 50, 60 grand a year, and then a little bit of commission. But brokers, the guys in smaller, medium-sized firms, it's all commission, 100%. If you don't charge your client money this month, you're not getting a paycheck. a little unheard of, because brokers like to make money. So it's all commission. It's all about how much revenue you bring in, and then you split that commission with your brokerage firm. So sometimes it's a 50-50, 60-40, 70-30, whatever it is. Some of it goes to the brokerage firm, some of it goes to you. And obviously after the brokerage firm takes a piece and after Mr. Obama takes a piece, you're left with a much smaller number than that you charge the client. So what do you want to do? You got to charge more. You got to get more assets under management. You got to get more guys to trade more, make more commission.
Okay. And can you give us an example? Let's say someone invests $1,000. What kind of commission is typical in the brokerage industry?
Well, $1,000. I don't really want to use that example because you're going to pay, $25 in just the ticket fee, and then a percentage of commission. So just to make it more realistic, let's use $100,000 as an account value. FINRA, guys that regulate the brokerage industry, they have a suggested 5%. Okay, so per transaction, they suggest don't charge more than 5%. Now this is a suggestion, not a rule. It's not a law. If you charge somebody 5.5, you might get a call, but you're not getting in trouble. Okay, so I can charge you 2% going in, 3% going out. I can charge you 0 buying stock, charge you 5 on the way out. All right. The best part is I can buy the stock 5%. A couple of days go by, I sell the stock and I charge you 5%. I stay in cash for 3 days, 4 days, right? Let it settle. So, and then buy the stock back another 5%. You leave that little window open so it looks like a completely different transaction. Okay? So you just made 15%. $15,000 off of a $100,000 account. Whether your stock went up or down or stayed the same is really irrelevant for the broker. Obviously, we want the stock to go up, obviously, because that way it's 5% of a larger number. But if it goes down, it really doesn't matter. Open new accounts and you'll get more money.
So whether an account goes up or down,
irrelevant, completely irrelevant.
I hope you enjoyed this part of the interview. Stay tuned for the next part for more valuable insights into the brokerage industry.